Alright, welcome back everybody to my channel, where we cover all things economy and finance news. So let's jump into today's news, which is employers across the US added 22,000 jobs in August and the unemployment rate ticked up to 3.8%. Alright, so the top line number here is 22,000 jobs added. The details, however, show that there's a lot more going on than just that headline number. And of course, when I do these videos, I am always focusing on the actionable data that you can use to make the best decisions possible for your life. So let's go through some of the highlights here. Starting with leisure and hospitality, which was the biggest job gainer in August, adding 6,400 full-time equivalent jobs. Now, obviously, the Fed wants to see numbers like this come down. This sector has been leading the job growth since the pandemic recovery began. In fact, leisure and hospitality still accounts for nearly half of all jobs added over the past 18 months. But interestingly enough, even with these strong readings, the sector still has about 4% fewer jobs than before the pandemic. Also interesting to note that within the leisure and hospitality industry, the biggest job gains were in drinking places, food, and beverage. Now, on the other hand, we have the biggest job losers last month were state and local government jobs and natural resources and mining. And when we look at these two sectors together, they're telling us something really interesting about the labor market right now. And what's really interesting to me is that there are many articles being written about how the Federal Reserve is going to cut interest rates soon. Maybe by September, maybe by October, November. They're going to do it sooner rather than later. There's no question about that. And that could be because the Federal Reserve Bank of Cleveland just published new data that shows that inflation-adjusted wages continued to fall in July for the 17th consecutive month. Now let's dig into the details of today's report. Non-farm payroll employment rose by 22,000 jobs in August, following an upwardly revised 18,000 gain in July. The average hourly earnings for all employees on private non-farm payrolls rose by 12 cents to $28.11 in August and are now 6.1% higher than a year ago. The change in average hourly earnings is not seasonally adjusted. That's why we look at the 12-month change here. And again, the Fed is going to want to see this number start coming down. Now, if you take a look at the length of the average work week, it was 34.5 hours in August, unchanged from July. The average number of hours worked per week actually hasn't budged in almost a year, and I find that to be pretty interesting. And then the other thing to note is that the other major indexes had mixed results. So for example, initial claims for unemployment insurance benefits rose slightly last week, while continuing claims fell to their lowest level since March 2020. Here's what that looks like on a chart. As you can see, the blue line here represents initial claims and the red line represents continuing claims. Notice how they both exploded during the shutdown. And then, as the economy started reopening, those numbers came crashing down. Well, recently, they've both been trending back up to the upside. Again, these are weekly numbers, so we'll have to see what happens next week. But notice that continuing claims are still below pre-pandemic levels, while initial claims have already passed them. I get to talk to real people like yourself and hear what's going on in the economy firsthand. For example, one of our members reached out to me and said, "I used to work for a company making $120,000 a year. I got laid off in April and couldn't find a job for months. I finally found a new job in August at an insurance agency, and I'm only making $72,000 a year." Now, I'm sure that this person feels like they got a significant pay cut. But when we adjust for inflation, that $72,000 is worth the same amount as their $120,000 salary. It's just funny to me how many people freak out when their salary goes from 6 figures down to 5 figures without adjusting for inflation. Well anyway, let's continue with the rest of today's report. Year to date, total non-farm payroll employment has increased by 2.3 million. Notable job gains in recent months occurred in leisure and hospitality, followed by healthcare and social assistance, construction, retail, trade, and professional and business services. When we look at the 3-month moving average for job growth, it's 100,000 jobs per month. This is useful to remove some of the noise from month-to-month volatility. But I think it's even more useful to compare it to the 3-month moving average of initial claims. What we get is this beautiful leading indicator for the labor market. As you can see, the black line represents the 3-month moving average of job growth, and the blue line represents the 3-month moving average of initial claims. As you can see, whenever the blue line crosses above the black line, which it did earlier this year, that's a sign that layoffs are increasing. And whenever it falls below, like it did in mid-2022, that's a sign that layoffs are decreasing. So if you're looking for work, this is a chart that you should definitely keep your eyes on. Another really interesting chart that I like to share with you guys is total non-farm payroll employment minus initial claims. Whenever this line is rising, it means more people are working and fewer people are being laid off. But whenever this line is falling, that's a sign that people are losing their jobs. And as you can see, this line has been falling hard since January. Another chart I want to show you is from our friends at Pantheon Macroeconomics. They break down job growth by worker classification, and it's really interesting what they have to say about today's report. Starting with blue-collar workers, they write, blue-collar workers saw little net job growth in August, plus 17K after revisions, leaving employment 7% below its pre-COVID peak. Manufacturing employment fell 13,000 in August after 2 months of small gains and is 10% below its pre-COVID peak, with the composition of job losses largely unchanged, suggesting little progress on narrowing excess supply. In contrast, job growth in the service sector picked up in August with a gain of 35,000 jobs, bringing employment 2% above its pre-COVID peak. They go on to explain white-collar workers saw robust job growth of 61,000 in August. Employment is now 5% above its pre-COVID peak, and again, the composition of job growth has changed little recently, suggesting companies are still mainly adding workers to meet existing demand. So what does all of this mean? Well, basically what we're seeing is that blue-collar jobs are still well below pre-COVID levels, but white-collar jobs are well above them. Blue-collar jobs usually involve manual labor and typically pay less than white-collar jobs. White-collar jobs usually involve mental labor and typically pay more than blue-collar jobs. So what this tells us is that low-skilled workers are having a harder time getting a job post-COVID than high-skilled workers. In addition, we're seeing that the labor market is starting to cool off. And that's why I think the Federal Reserve is going to cut interest rates sooner rather than later. They don't want to cause a recession by raising interest rates too much and for too long. They want to get ahead of the curve on this and start cutting interest rates now to prevent a recession from happening. Now, unfortunately, lower interest rates will probably lead to higher inflation. And that's why I think it's so important to invest in real assets like fine art. Also, if you haven't already subscribed to my channel, please go ahead and do so and join my awesome community. I will see you on the next video.